Welcome, everyone, to the Kimberlite Hydraulic Fracturing Services webinar. My name is David Batt, President of Kimberlite Research, and I'm glad that you're able to join us today. This is the 12th in the webinar series that we've been extending each month to the oil and gas operators. Our past webinars have included reviews of many of the oil field products and services most commonly used in the industry, such as drilling services, artificial lift, cementing services, surface wellheads, subsea equipment, and even pipeline integrity and inline inspection services. We've also taken deep dives into the Permian Basin, as well as to the performance comparisons of the big three oil field service suppliers, Schlumberger, Halliburton, and Baker Hughes. Just last month, we reviewed the global drilling services market, and we took a deep dive into the downhole mud motors, MWD, rotary steerable systems, drill bits, and drilling fluids. Let us know if any of your colleagues would like access to these prior webinars. Send us an email or a chat message today. Today, we'll be reviewing the hydraulic fracturing services market, including updates on ESG, dual fuel versus electric, simultaneous or dual fracturing, and other technologies, as well as looking at how the competitive landscape stacks up among both the large and the small hydraulic fracturing service suppliers in terms of their performance and service quality across the various geographies and customer groups. Feel free to submit questions during the presentation today. You can send us a chat box or an email message, and we'll try to address the questions throughout the presentation. For those of you that are not that familiar with Kimberlite Research, I'll provide a very brief background and then dive into the hydraulic fracturing services review. Each year, Kimberlite Research Each year, Kimberlite Research conducts approximately 3,000 one-on-one phone interviews with oil and gas operators globally. Some of you on the call may have participated in prior industry surveys with Kimberlite Research, and for that, I say thank you, because with your help and contribution, we're able to provide these market analytics and feedback to you, as well as benchmark the industry on a whole host of technology adoption trends and supplier performance. Our research is about 50% international, 50% North America. Needless to say, today we'll be focusing on hydraulic fracturing, so it is principally North America focused, but we do prepare a series of reports crossing formation evaluation, drilling services, completion services, production, and subsea. But the findings in the analysis today will be on the hydraulic fracturing market, and these are based with interviews with 205 completion engineers and managers during the months of June, July, and August of 2021, representing feedback from over 130 different oil and gas operators worldwide. The data set is fairly rich and dimensional. In this exhibit, we cross-plot supplier performance on the x-axis versus pricing competitiveness on the y-axis. And before diving into the presentation, I just want to make sure everyone's familiar with this particular exhibit, the value map, we call it at Kimberlite, because this is basically a visual picture depicting the competitive landscape and the positioning of each supplier. The top right-hand quadrant is known as the premium offering quadrant, where oilfield service company suppliers perform better than industry average. They may charge prices slightly higher than industry norm, but they may cost more, but they're worth it. At the opposing bottom left-hand quadrant is the discount offering quadrant, where suppliers underperform the market, but they offset their underperformance with attractive pricing, and they're positioned as a discount provider. And even though they're not industry leading in performance, you get what you pay for. The bottom right is value advantaged, and the top left is competitively disadvantaged. Any suppliers plotting in top left, based on the reviews of yourselves, the customers, oil and gas operators, you're basically communicating that their overall performance profile and their pricing strategies are not very competitive and that there are better values in the marketplace. So with that, we'll go ahead and dive in. Again, feel free to send chat messages as you like, if we can try to address questions as we go. We'll first start off by kind of addressing the sentiment of the market. When we ask the oil and gas operators if they're going to be increasing their hydraulic fracturing service expenditures over the next 12 months, we find that 2/3 of you, 64%, plan to increase expenditures, while only 4% plan to decrease hydraulic fracturing expenditures and activity moving forward. The diffusion index, as it's known, down here at the bottom, is above 50 in every basin that we track, reflecting expansion in the market. If we trend this diffusion index as we were going into the COVID downturn and into 2020, you will see that even in 2019, the hydraulic fracturing market had already entered contraction mode and had dipped down below the critical 50 index marker, except for the Permian Basin, reflecting that you, oil and gas operators, were beginning to decrease your spending and moderate your spending. But in large measure, what we saw here was a lot of efficiencies were being realized, if you recall. If you go back to 2019 time frame, you may recall that we in the United States, we were producing over 13 million barrels of oil a day, and we were doing it with a decreasing number of drilling rigs and a decreasing number of hydraulic fracturing crews. And a lot of that was just because you, the oil and gas operators, in conjunction with collaboration from the oilfield service companies, were able to achieve more with less. You were able to drill the wells more quickly, complete the wells more quickly, and able to improve the productivity of the wells. And so a lot was going forward. And then obviously we hit bottom of COVID when we dropped down to about 40, 50 hydraulic fracturing crews and down to really historic lows, both drilling rigs as well. You can see that the diffusion index is a very sharp V-shaped recovery here with drilling activity, drilling rigs back up at about the 500 level, and frac crews back up to about 240 or so crews, but certainly not back to pre-COVID levels and not expected to return to those levels given the efficiencies that are being achieved in the marketplace. Looking ahead to 2022, oil and gas operators, yourselves, are projecting to drill about 13% more wells on average in United States land in 2022 versus 2021. A little bit more in Canada, about mid-20s, and internationally about 12%. So this is all very favorable backdrop for forward growth and what many believe will be a multi-year growth cycle for 2022, 23, 24. And that's going to place all types of constraints onto the market for you as an oil and gas operator, because you as an operator as well as the oilfield service companies are really focusing more on returns to shareholders than growth for growth's sake. And so as a consequence, investment capital into the oil and gas industry will be moderated based on the ability to generate returns. You can see this is data from Primary Vision and Baker Hughes rig count, just showing how the frac crews and drilling rig count compressed here as we were working down DUCs. But you can see how they spread back apart now that we're kind of getting back into more of a normal rhythm. In terms of pricing, inflationary pressures are certainly very prominent today. About 80% of the oil and gas operators that we talk to expect pricing to go up. These are real price increases driven by inflation, cost of labor, cost of goods and materials, cost of transportation. Just for example, the ship of empty container from the west coast of the United States back to China cost $900, but to ship it back with goods and services in that 40-foot container costs $20,000 to $25,000. And so transportation costs are just hitting extraordinary highs. Not to mention there's tariffs as well for certain countries like China coming from overseas. This impacts as it relates to hydraulic fracturing services, pump parts and maintenance and repair, as well as labor cost, transportation cost, and fuel cost. And so the average price increase that is anticipated to be moving forward into the market as the later half of 21 and the 22 is probably about 10%. Every year in this graph, you can see that we're able to reduce the number of days to drill a well, and we were able to reduce the number of days to complete a well, even though we were drilling longer laterals with more frac stages and pumping more proppant of sand per lateral foot, more water. And so we were getting more done with less, doing it more quickly, and these were the efficiencies that we were seeing. You can see in 2021, though, these efficiencies leveled off. Many of these were COVID-related and logistics-related. You can see that in United States land right here, even though lateral length didn't materially change, the number of days went up by 4%. And while the number of stages did increase and the amount of sand per lateral foot increased, and that was, you may recall in the 2020 report out, Number of stage lengths got lengthened and sand uses got reduced back in 2020 due to cost-saving measures. But now oil prices firmly in very attractive area of $60 to $70, you can see that the oil and gas operators are returning back to the optimal number of stages and the optimal amount of sand per lateral foot. But even so, the number of days to complete a well has increased by 10%. In terms of where additional efficiencies could come into the marketplace, certainly simultaneous or dual fracturing operations could certainly be an area for additional efficiencies to be realized in the market. About 1 in 4 to 1 in 5 of the operators that we interviewed in North America land have tried dual fracturing or simultaneous hydraulic fracturing, and the efficiency gains on average realized are about 30-31%. So the economic gains are certainly material and certainly worth making the effort of the oil and gas operators to work collaboratively with the oil field service companies to see where this type of approach to completing the well can be applied. However, what we find is it's not applicable to everyone, and only moving forward into 2022, we only anticipate about 21% of the wells to be completed using this method. Now, this is still a step up, roughly from the 6% of wells completed in 2020 using simultaneous hydraulic fracturing. That increased to about 13% of the wells in 2021 and will continue to increase to 21% in 2022. But keep in mind that this isn't for everyone, because in order to perform simultaneous hydraulic fracturing, you must have a pad that's sufficiently sized with a sufficient number of wells. 2, you must have very robust supply chain logistics to be able to handle the volume of trucks and sand and water movement. Even though we think of this as somewhat of a manufacturing process, the fact remains this is a job site. And it's a temporary job site, and to be able to move that many trucks, you can only move so many trucks across a job site in a given day safely. And so it's really not for everyone. We find that certain operators are trying to use simultaneous hydraulic fracturing for 50% to 100% of their wells, but then there's a whole host of operators, about half of them say it's just not applicable given their lease acreage, the contiguous nature of their leasehold. They may only be drilling 1 or 2 or 3 wells per pad rather than 4, 5, 6, or 7 or 8 wells per pad. So lots of things will limit broad-based adoption of simultaneous hydraulic fracturing. Moving to the very critical topic of dual fuel versus electric, oil and gas operators still prefer dual fuel over electric at a nearly 2-to-1 ratio, principally driven just by the fact that dual fuel has an established track record of performance. You need the flexibility where electric infrastructure or field gas may not be available. And so even though oil and gas operators believe that electric frac fleets do offer the lowest emission fleet level, or the lowest emission fleet technology available, they still prefer dual fuel at a 2-to-1 ratio. Certainly it's a big if though, if we were to use renewable diesel, then certainly conventional diesel with renewable fuel would probably actually be the lowest emission impact to the climate. Big change here. About 47, close to 50% of North America land operators express feeling major pressure to reduce emissions, followed by another 28%. The velocity at which the ESG movement and climate change concerns is growing. Certainly there's a need and a desire to want to reduce flaring and to reduce emissions, and so that will continue to dictate many of the technologies and investment decisions moving forward. We at Kimberlite have a lot of insights in this particular area, so if anyone wants to delve in more deeply, feel free to reach out to us. When we ask the oil and gas operators how the various oil field service companies can help the oil companies meet their ESG objectives, they're basically saying, please make dual fuel and electric fleets more available, more affordable, and more reliable. Certainly there's a cost associated with this. As I just mentioned, everyone's trying to operate within means. Everyone's trying to focus on returns and not growth for growth's sake. So as an operator, if you really want more dual fuel and electric frac fleets, I really encourage you to work collaboratively with your oil field service company suppliers to help make this a reality, because the additional capital required to invest in dual fuel and electric frac fleets will not simply happen at current pricing levels today. It simply doesn't pencil out. And so in order to get there, the industry will have to work together to get there. Fortunately, with today's elevated oil prices, oil companies are generating, on average, for the most part, very sufficient cash flows to be able to make intelligent investments into these technologies if it's something that the industry would like to see made happen. We did ask a new question in the 21 survey about how frequently you as an operator would be willing to consider using real-time subsurface frac measurements to optimize pumping and fracture placement in response to reservoir behavior if this technology was available at a reasonable price. Now, granted, we didn't define what a reasonable price was, but we also know intuitively that, many of the frac stages that you complete really are not contributing to the productivity of the wellbore. And so being able to, use subsurface measurements to optimize pump rates and pressures to prevent against screen outs and to optimize fracture propagation certainly makes a lot of sense. Myself, as a geologist that used to work for Chevron, I certainly understand that, and I'm sure others on the call today would recognize that as well. But generally speaking, what we find is about maybe 1 in 5 are open to considering it frequently for most all wells, and about another 1 in 3 are willing to consider using it for maybe 1 well per pad. So many of the leaders in the industry, such as Halliburton, are developing this type of real-time technology. Liberty Oilfield Services is developing this technology, and I believe NexTier is recently rolling out their DigiFrac technologies as well. And so again, this would be another area I think that could help drive efficiencies into the marketplace in terms of return on investment and productivity of wells. Just looking at some quick trends before we jump into the supplier performance overview, we find that the use of brown sand just continues to grow, and it's almost the only form of sand used in the Permian Basin in Eagle Ford and Mid-Con, mainly due to cost savings. 100 mesh continues to be the most heavily used proppant used by size. You can just see in the past few years how the use of brown sand in the Permian Basin has grown from 50% up to 89%. So the adoption and use of brown sand has been very, 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 very strong. Of course, making sure that you have good quality sand without rocks or pebbles in it to tear out the pumps and blenders is kind of critically important, but certainly cost is a big driver that's driving the adoption of brown sand. You can see back in 2020, we backed off on the amount of proppant used per lateral foot as a cost savings measures, but like I said, in 2021, with oil prices where they are, you can see that the oil and gas operators are beginning to get back to the levels of stage count and stage length and proppant per lateral foot that they desire to see happen. Boxes continues to be very popular, basically displacing Sand Kings. Silos remains pretty preferred, remaining by about a third of the operators that we survey, and it's been that way now for the last 3 years. One of the things about silos, though, and I think Solaris offers one of the major suppliers for silos, is they've been introducing new technologies to reduce dust and to improve efficiencies and logistics at the site. Silos have always been accredited for having a small footprint, and certainly if you're going to do simultaneous dual fracturing, having a 12-pack on site could be very helpful in terms of capturing a bunch of sand in a very contained area and logistically trying to handle all the activity at a job site. Boxes are still viewed very favorably for moving, mobilization, flexibility, less dust, and logistics. So it'll be interesting to see with these new technologies for silos if silo use and adoption begins to continue to increase. In terms of water consumption, water use is continuing on the left-hand side of this graph to increase, but also the share of water coming from recycled sources is continuing to grow. I think in the Permian Basin, the percent of water coming from recycled uses was about 36–38% amongst the operators surveyed. Oil and gas operators share with us that they still prefer to bundle their chemical purchases with their pumping supplier about 71% of the time, and their profit with their pumping supplier about 62% of the time. Dissolvable plug use is increasing. It kind of took a pause from 19 to 20, but it seems to have picked up in many basins amongst operators that we surveyed. Lateral lengths have begun to kind of flatten out. I think we're going to switch gears now into maybe the key part of the report. I'll skip some of the image factors in the marketplace, but just real quick, just generally speaking, amongst users and non-users, you can see that the image of Liberty Oilfield Services is exceptionally strong, even though they're not as large as a Halliburton per se. Many operators have a very positive image in the marketplace amongst Liberty Oilfield Services, just like they do for Halliburton. Halliburton stands out for technical support and being a technology leader in the industry. NexTier's image is also improving amongst users and non-users. In the main part of the report, for those of you that have contributed to our research, you may recall that we asked several open-ended questions to the completion engineers and managers that we interview. And certainly one of them is, who do you use for hydraulic fracturing services? And so when you look at the market over here on the right-hand side, you, the oil and gas operator, have been consolidating your use of hydraulic fracturing service suppliers from nearly 3 suppliers back in 2017 at 2.66 down to about 2 suppliers, about 1.72 in the 21 survey. We also see, while your consolidation and use of suppliers has been reduced by about a third, we also see that the number of frac suppliers in the market has also consolidated by about a third. There were 30 different frac suppliers cited as being used in 2019. We're down to 21 frac suppliers cited in the 21 report. But now that Alamo is part of NexTier, and we're down to 20. You can see that Liberty Oilfield Services and Halliburton have the deepest penetration into the market, with more operators citing use of those 2 suppliers, followed by NexTier. Then you see FTS, ProPetro in the Permian Basin, ProFrac, and so forth. And so certainly we're seeing some changing landscape in terms of use and adoption by the suppliers. When we ask you, the oil and gas operator, to rate the performance of the hydraulic fracturing service suppliers with whom you use, so this is your chance as an operator to anonymously provide feedback on the performance of the suppliers on a scale of 1 to 10, with 10 being outstanding performance and 1 being very poor performance. What you see here is, through your eyes, the end user, oil and gas operator, the hydraulic fracturing service suppliers are not performing homogeneously the same. Some are getting average ratings in the 6s, some are getting on the low side. The top performers are getting average ratings close to 9. Now, keep in mind, these are averages, so their ratings could range from 1 to 10, and their average could be 6.60, all right? And so what happens is, when we begin to objectively benchmark the performance of the suppliers and look at the industry trends, like in this graph for U.S. land, the dashed line is the industry average line, and you can see that the dashed line is improving just about every year from 2017, reflecting that you, the operator, felt like the responsiveness to needs is improving. You can also see from this performance trend map that not all hydraulic fracturing service suppliers are performing uniformly the same. Some are consistently receiving customer reviews that are better than industry average, such as this green line right here for Liberty Oilfield Services. You can see that others have been kind of gyrating a little bit more up and down from year to year. And so from an oil company's perspective, if you've only used 1 or 2 hydraulic fracturing service suppliers, you'll have great insight as to how those 1 or 2 oilfield service company suppliers are performing. But when you look at the entire market based on the feedback given by you and all your peers in the industry, you begin to realize that it's not a static performance level here. It's changing. There are reasons why it changes from year to year. It could be mergers and acquisitions. It could be personnel changes. It could be downturns. It could be reductions in forces. But generally speaking, what we find is overall, the industry review ratings that they're getting better each year, and that you as an operator, for the most part, are seeing an improvement in the performance and the service that you're receiving from the industry at large. Certainly, you clearly see trends of stability, with certain operators like Liberty consistently getting customer reviews that are better than industry average. Even Halliburton, for technical support, continually getting industry reviews that are better than industry average, whereas you saw for responsiveness to needs, Halliburton's responsiveness to needs customer review ratings typically tended to track slightly below industry average. And so it's important to do your homework as an oil and gas operator, to truly do due diligence and benchmark the suppliers, recognizing that they don't all perform the same. When we translate this, say, into a value map, which is, if you recall, is the visual picture, if you will, of the competitive landscape, what we find is that certain suppliers stand out in the top right-hand quadrant, like Liberty Oilfield Services, even Evolution with their electric fluid technology. Others like ProPetro and Quasar, Alamo, that's now part of NexTier, were viewed as being value advantaged. Halliburton provides strong pricing leadership for the market, have a tremendous market size and share. And then you've got a whole host of other suppliers that are really kind of viewed as discount providers, where you get what you pay for as long as you know what you're getting. And then you've got Universal and FTS that tend to be more or less value advantage suppliers. Now keep in mind, the performance is not consistent from basin to basin. So if we were to go in, say, to the Permian Basin, you would find that, Alamo, Quasar, Liberty, even NexTier and ProPetro and FTS International really tend to be some of the more value advantage suppliers in the Permian Basin. For the first time in 6 years, Halliburton moved from this top right-hand quadrant, cost more but worth it, into the top left-hand quadrant. And that's the first time we've seen that happen for Halliburton in 6 years. So I certainly would not expect Halliburton to stay here. They're very adept at what they do, and I would expect to see perhaps this report being as a wake-up call to kind of move back into the top right-hand quadrant. As we move into, say, the Bakken, for example, you can see how Liberty and Calfrac are viewed as competitively advantaged in delivering some of the best value, whereas when you move into the Eagle Ford, you see Halliburton, Liberty, Universal, Calfrac, and Alamo all receiving customer review ratings that are viewed as being better than industry average. Moving into the Rockies, which is kind of the backyard for Liberty Oilfield Services, you see that they have a very strong positioning in the eyes of the end users as delivering solid value, as being a premium supplier. Halliburton also viewed as a premium supplier in the region. When you move to the Marcellus, you see that Universal is strongly value advantaged along with NexTier. Liberty is just now beginning to move some horsepower into the region and currently has a very favorable view, but very small presence as it just starting to ramp up as we speak. Halliburton, again, is a premium supplier in the region. In the Mid-Con, you see Gore Nitrogen being a local provider viewed very favorably. In the Haynesville, you can see, Liberty very solidly positioned, ProFrac, NexTier, FTS, all viewed as delivering better performance in the market that's viewed as being better than industry average through the eyes of the Haynesville oil and gas operators. And in Canada, if anyone is on the call from Canada, you can see how the competitive landscape is a bit tighter here in Canada. Trican tends to underperform year on year for the last 4 or 5, 6 years. Calfrac is typically in a value advantage quadrant and recently, moved up on the pricing. And then the company called Iron Horse, whoever they are, currently receiving customer reviews that differentiate from the rest of the pack. If we were to kind of take a look, say, at some supplier performance summaries really quick among some of these suppliers, if you take a look at Halliburton, one of the things you see about Halliburton is they're very consistently year to year viewed as kind of being that premium supplier, cost more but worth it. As you know, Halliburton is the leader in hydraulic fracturing in most people's eyes as it relates to technology and technical support, certainly by size. When you look at their performance profile and value profile, what you find is that in certain regions, they certainly live up to that image, cost more but worth it, and in certain regions, perhaps they're exposing themselves in that their performance profile isn't quite correlating with their pricing strategies. You can see that their customer loyalty ratings here on the bottom right-hand part of the graph historically were higher than industry average, but have since, right here, have converged to industry average and then kind of fell below industry average. So their customer loyalty rating is measured by the Net Promoter Score is currently below industry average. If you take a look at Liberty Oilfield Services by comparison, you can see historically each year their customer review ratings each year have consistently been viewed as better than industry average. However, if you look at their basinal performance, what you see with the acquisition of all the Schlumberger assets, you start to see some variance in performance from basin to basin. It's a little bit more broad of a variance than you would normally see with Liberty Oilfield Services pre-acquisition of the Schlumberger assets. So there's a lot to digest here with the assets, and so we'll be looking to see in 2022 if Liberty is able to standardize and drive consistency in performance across the various basins through the eyes of the end users. Liberty has extremely high customer loyalty ratings that are significantly higher than the industry average would certainly correlate with their better than industry average customer review ratings on responsiveness to needs and equipment, field service, and so forth. I failed to mention on the Halliburton graph above that they typically stand out again for technical support and equipment performance. When you look at next tier, now next tier, if you recall, is really the acclamation of what you got: Rockpile, you've got Keen, you've got C&J, you've got Trican, and now you have Alamo. We plotted Alamo on this map because the transaction just closed about a month ago, and you can see that the Alamo assets and performance will certainly be accretive to the overall next tier profile. Next tier, though, is viewed favorably and competitive in the Permian, Marcellus, and Haynesville. They're viewed more of a discount provider in the Rockies and Eagle Ford. Their customer loyalty ratings have historically trended below industry average and certainly correlate with what's considered to be below industry average customer review ratings. But again, geographic variances are observed. ProPetro is obviously Permian-based. You can see that historically they're viewed as a value advantage supplier. It was the 1 year of the organizational transition where we saw a disruption in pricing strategy and performance profile. But for the most part, their customer loyalty rating is better than industry average. If you look at FTS International, while they've historically been positioned as a value advantage supplier or a discount provider, they have a very loyal following of customers, and you can see that their customer loyalty ratings are higher than industry average for the last 3 years running. And you can see in certain basins, particularly the Permian and the Haynesville, they're viewed as delivering strong value, as well as in the Eagle Ford. When you move into Universal has been in the hydraulic fracturing business for many years. They've traditionally been a value advantage supplier. They demonstrate through the eyes of the customer and customer reviews performance strengths in the Marcellus and Eagle Ford, and certainly positioned as acceptable values in the Mid-Con and Permian. They too have a loyal following of clients and customers and operators that use them. The operators that use Universal typically find their performance to be acceptable, and as a consequence, their customer loyalty ratings tend to be higher than the industry average. If you take a look at Calfrac, they're typically a value advantage supplier in the Eagle Ford Bakken in Canada. They've been in and out of the Permian a little bit. You can see that their customer loyalty ratings historically are higher than industry average, but have taken a slight decline most recently, which corresponds to their broader performance profile. Profac's pricing strategies are inconsistent from basin to basin. Their customer loyalty ratings have declined as well. And so their competitive position has shifted. It'd be interesting to see if they stabilize in 2022, or if they're trying just to reposition more fair to a premium supplier. But if they wish to do that, they just need to drive consistency in their performance, particularly in the Permian and Marcellus, to support current pricing strategies. U.S. Well Services, principally has an electric fleet. They're really known for having really good ESG profiles. Their operational performance, though, for the last 3 years has been viewed as being below industry average, corresponding with their customer loyalty ratings that are also below industry average. And so while they have really good clean fleet technology, I think U.S. Well Services will certainly benefit as they continue to improve service quality and performance in the field. And CUD is a discount provider in the Permian Basin, and then Trican in Canada, as I mentioned, typically near the fair value fairway that runs diagonally here, but typically receiving customer performance reviews that are close to industry norm to below industry norm in most years, with customer loyalty ratings that are below the industry norm and average. Step Energy in Canada, on par with industry norm performance, customer loyalty ratings better than industry average. When we take a look at buying behaviors, we find that the markets are not 100% price, service, or technology driven, that usually oil and gas operators, yourselves, will tend to emphasize price or technology or service in your selection, and that the markets tend to be a little bit segmented in that regard. And with that, I think I'm going to see if there's any questions from anyone attending the webinar real quick. So I'll wait to see. Oh, there's someone from Canada. Oh, Canada, cool. I think one of the things as an operator you really need to be cognizant about is I've been in this industry since the mid-1980s when I joined Chevron. And, 21 years ago, I led the creation of Chevron Energy Solutions in July of 2000 for the energy transition. And fast forward to 21 years, here we are, we're talking about the same thing that I was talking about 21 years ago. This time it seems to have some legs attached to it. But given the current regulatory environment and assuming OPEC Plus maintains their discipline, pricing should be in a level that's going to drive sufficient cash flows. But at the same time, of all the supply chain constraints and inflationary pressures that are described as being temporary or transitory, right now they seem to be quite a bit permanently transitory. And so I think we really need to set yourself up for the reality of the fact that regardless, in your business, from drilling to completion to production, these supply chain constraints and these inflationary pressures are extremely real. And even though many of you may have had some price increases in the first half of 2021 due to inflationary cost of raw materials, transportation, and labor costs, for the most part, when you look at the financial readouts of these oilfield service company suppliers, many of them are still struggling to get the cash flow positive. Many of them are at net neutral. And so as we as an industry need to continue to invest into new technologies, be it dual fuel, electric frac fleets, and such, I really encourage you to collaboratively work closely with the oilfield service company suppliers, because it's really through that collaboration that we're going to kind of most efficiently get to where we need to be. I hope that one thing that I was able to describe to you today, that for those of you that think hydraulic fracturing services is just a commodity item and one pumper is no different than another pumper, we just don't have any evidence on the thousands and thousands of customer review ratings that we've amassed over the last 6 years as we update this study every year since 2016. I don't know, well over 20,000 customer review ratings that in supplier performance ratings, that there's just so much variability from supplier to supplier, from basin to basin, from year to year, that encourage you to really search out best value and try to seek the suppliers that best fit your operational profile and your culture. We recognize that different oil companies have different cultures and different approaches. Some are able to do simultaneous hydraulic fracturing, others are not, and so forth. And so feel free to reach out if you have questions, if we can help you at Kimberlite and trying to make your best business decisions to get best value for your company. But recognize that we really are into this industry together. And even though people think, oil and gas may be going away by 2025 or 2030 or 2040, that's simply not reality. And so fossil fuels will be around for some time to come. And it's unfortunate right now that, we're under such scrutiny. But we will get cleaner as an industry, and we'll continue to lead the industry in the world as being able to deliver affordable energy and with the lowest carbon footprint anywhere in the world. I want to thank you all for participating in this webinar. I want to thank everyone that contributes to our industry surveys. Next month, we'll be reporting out on the perforating survey. It'll be interesting, so you can see how next year for pump down perforating, they acquired the Schlumberger assets. Liberty Oilfield Services acquired the Schlumberger assets for pump down perforating, how Liberty is comparing to Halliburton versus NexTier. And we'll be able to cover that in October on the perforating webinar. So with that, thanks again, and we'll sign off here, but feel free to reach out if you have any questions. Bye now.